is on the screen. It's Melba Limited, has an authorised capital of 1.5 million, divided into 1.1 million ordinary shares and 400,000 preference shares. This information will go into the balance sheet. And then we're given a trial balance. So just a few things I always look for in the balance sheet. Sorry, the trial balance. We have buildings at cost, but there's no mention of depreciation. That's unusual, but there's no depreciation. Delivery vans cost 250, net book value 170, so there's going to be depreciation there of 80,000 accumulated depreciation. We have discount, we have profit and loss, we have stock, debenture interest for the first 6 months. That's interesting. So just bear that in mind. Investments, patents incorporating 4 months investment income. Again, interesting. And the rest seems fairly straightforward. Moving down, we have 8 notes. So that will probably equate to around 8 or 9 workings. Okay, and the way I approach the question, I go through each working in turn, and that's what I'm going to do now. Once you have those done, you're going ahead to prepare the trading profit and loss, 75 marks, and the balance sheet, 45 marks. You have to know the layout of the trading profit and loss and the balance sheet. This is just practice and doing questions over and over and over and over until you know the layout. Once you know the notes, you can put the figures where they're meant to go. So let's look at note number 1. At the 31st of the 12th, at cost was 80,400. This figure includes damaged stock, which cost 6,600, but which now has a realisable value of 3,200. So stock has basically lost value of 6,600 minus 3,200. Stock has lost value of 3,400. Okay, so what you're going to do, you're going to take that 3,400, which is the lost value, you're going to take that away from the 80,400. So 80,400, take away loss in value, which equals 77,000. At the moment, that is our trading figure and our current assets figure. What often happens is there may be extra notes as we go along. That figure may change or may not change. If it does change, what I do is come back and score it out. If I don't score it out, then it goes into the accounts. Question number 2, patents. Incorporating investment income written off over a 5-year period. So first of all, investment income is what we are dealing with first. Look back to the trial balance at investments. Up here, 3% investments, 350,000 for a year. Okay, so first of all, 3% of 350,000 gives you 10,500. That's your P&L figure for investment income for the year. We must take away 4 months though. And 4 months, when you work that out, is 3,500, which leaves us with 7,000 still due. That's a current asset, investment income due. Okay, so 2 figures that will go to the accounts here. 10,500 is your P&L figure, and 7,000 is your current asset figure. This 3,500 is going to go into the patents. Our opening balance on patents from the trial balance is 21,500. We're going to add 4 months on 3,500, and that adds up to 25,000. We are told patents are written off over a 5-year period up here, 5-year period. Therefore, 25,000 divided by 5, you should be able to do this in your head, is 5,000 every year patent written off. That goes into your P&L. So that's called patent written off, which is an admin expense. When we balance the patents now, we get a balance of 20,000. We bring it down on the debit side, and patents is an intangible asset. Okay, so 4 figures. 10,500 is investment income in the P&L. 7,000 investment income due, current asset. 5,000 admin expense, patents written off. 20,000 intangible asset. That is your patents figure. Okay, moving on. Note number 3 is suspense. The suspense figure arises as a result of an incorrect figure for debenture interest, although the correct entry had been made in the bank account, and discount allowed 400 entered only in the discount account. So this is a common enough note. So debenture interest would be our first T account. Discount allowed entered only in the discount account. The discount allowed would link up with debtors. That should be debtors. And the third account we're looking for is we've looked for suspense in the trial balance. It is salaries and general expenses. And the figure is 231,100. The figure for debenture interest is 16,200. And the figure for what was the third thing was debtors 99,200. Okay, so debenture interest figure 16,200, debtors figure 99,200, and the third salaries and general expenses. I'm going to put suspense in brackets so we know that we're going to be dealing with that every time. Okay, so first of all, we better work out the correct debenture interest. So the debenture, if we look at the debenture, was 8% of 400,000. 8% of 400,000 is our interest for the year, which is 32,000. That's your P&L figure for the year. Less 6 months, which, if you work that out, 6 months is half of that, 16,000, which leaves you with 16,000 due, which is balance sheet current liability. So we have 2 figures here. We have debenture interest for the year in the P&L, and we have debenture interest due 16,000 balance sheet current liability. 2 figures there. I'll just circle them to make them stand out even more. This 16,000 is what should have been paid. Look over here though, 16,200. That's wrong. We must reduce that by 200. Once we credit debenture interest, we must debit the suspense, 200. I should have put the salaries and general expenses figure in here first of all as well. So we credit debenture interest to make that 16,000. We debit the other account, the suspense account. Actually, debenture interest account, I don't need to do anymore. That's fine. We've done it up here. Second thing, discount allowed was entered only in the discount account. A discount allowed would reduce your debtors by 400. So credit debtors, debit salaries and general expenses. That's it for that note. So we add up or we balance the salaries and general expenses. We get 231,700. When we balance the debtors account, we get 98,800. If you balanced it out, I'm just doing it quick here. So the 98,800 would be a current asset, debtors figure. Okay, and the salaries and general expenses would be an admin expense in the P&L account. Okay, So that's where that figure would go. So two more figures, new debtors figure, salaries and general expenses figure. Working number 4, stock was destroyed by fire. Insurance company agreed to pay compensation of 5,000. Okay, as you can see, stock was 6,000, the compensation were only given us 5,000. So what we do is purchases minus 6,000. We have a loss of 1,000, and we have compensation of 5,000. Okay, so the purchases, I'm going to just look back a couple of notes. We haven't adjusted purchases yet. So the purchases figure comes straight from the trial balance, which is 1,120,000. 112,000 minus 6,000, which gives us 111,400. That figure there is your trading figure for purchases. Okay, so that's your trading figure for purchases. The 1,000 is going to go in as an expense, an admin expense in the P&L, loss on fire. The compensation is going to go in the balance sheet as a current asset. So 3 figures: purchases, loss from fire, compensation. Working number 5, depreciation. This is a straightforward depreciation note. If you have practiced a lot of these questions, you will be able to do these okay. You're looking for 5 numbers here. You're looking for delivery van number, depreciation for the year, accumulated depreciation, disposal figure or loss or profit or loss on disposal, and the new purchases figure. So follow this method every time and you can't go wrong. Okay, disposal account and purchases account. So first of all, provide for depreciation on delivery vans at an annual rate of 15% of cost from the date of purchase to the date of sale. On the 31st of March, a delivery van which cost 30,000 on the 31st of March in 2011 was traded against a new van. We were given a trade-in allowance of 8,000, but the actual amount of the transaction, the net amount of the transaction, was incorrectly treated as purchase of trading stock. So a few things we have to do here. First of all, we get our opening balance for delivery vans, for depreciation, and for purchases. Now, we go to the last note for purchases, 111,400. I'm going to cross that out because we're not going to use that again. 111,400. Okay. We go to the trial balance for delivery vans, 250,000. And I made a note at the beginning, the depreciation is up here, 80,000. 80,000. Okay. I don't want that in red. Okay, so from here, we're going to go through step by step what we do. So first of all, the old delivery van cost 30,000. We're going to get rid of it. So we're going to credit delivery vans. 30,000. Okay, and we're going to debit the disposal account, 30,000. When you dispose of something, you also must dispose of its depreciation. So let's work that out first of all. We bought the van in 2011 in March. So in 2011, we had it for 9 months. Then we had it in 2012. for 12 months. In 2013 for 12 months. And in 2014, we sold the van after 3 months. In total, that's 36 months. So let's work out what the depreciation would have been on it. 30,000 times 15% divided by 12 gives us 1 month, multiplied by 36 months gives us 13,500. So debit depreciation, 13,500. That's called disposal. If we debit depreciation, we credit the disposal account. 13,500. Okay, I don't want that red. Keeps coming up red. Okay, that's it. Next, what do? We have, I'm just going to insert a new row here. Bear with me a second. Okay, we have an allowance of 8,000. So there was an allowance of 8,000 on a delivery van. That was incorrectly treated as a purchase. So we debit delivery vans and we credit the disposal account. 8,000. Okay, so we debit the delivery vans and we credit the disposal account. Last thing we do, we get told up here, the new van was 56,000, the allowance was 8, which means we actually paid that minus that, 56 minus 8, 48,000 from our bank account. That was wrongly treated as a purchase. So we credit 48,000. Okay, so at the moment, that's all the information we're told above. We can start finding out a few figures here. So we can balance the purchases account and we get a new purchases balance of 1066000, and that will come down here, 1066000. That is your new purchases figure in the trading account. I will highlight that in red. Secondly, we can work out, did we make a profit or a loss on disposal? I can tell you straight away we made a loss, and the loss is, when we add up these figures, we're trying to find the missing figure, 8,500 loss. That will be a P&L expense. If it was a gain, it would be on the other side and it would be a gain. So I'm going to highlight that in red, and I'll just explain that in a second. So if you think about it logically, we bought the van for 30,000, depreciate it by 13,500, the van would be worth 16,500. They only gave us a trade-in of 8,000. It was worth 16.5, they gave us 8, we've clearly lost money there. Thirdly, we can balance the delivery vans account. 276,000, that will balance out. That figure there is going to be your fixed asset for delivery vans. I'm going to put that in red. Okay. Now, two things we have to work out. We have to work out our P&L depreciation and our accumulated depreciation to finish this question off. So for the first 3 months of the year, because we bought and we sold a van, remember? So for the first 3 months of the year, delivery van balance was 250,000 times 15% times 3 over 12, first 3 months of the year. That gives us 9,375. For the remainder of the year, 9 months, our vans were worth this much, 276,000. times 15% times 9/12, which gives us 31,050 for a total of 40,425. That goes up here, 40,425. That is a selling and distribution expense because it's a delivery van. It's an S&D expense. Okay, when we balance this out, we get a balance of 106,925. 106,925. That figure there is our balance sheet figure for accumulated depreciation. So 5 figures we should have. New van figure, 276,000. Loss on disposal of van, 8,500. New purchases figure, 1,066,000. Depreciation for the year, 40,425. And accumulated depreciation on motor vans, 106,925. That's a big note. It's worth, could be 15, 20 marks, which is about 4% of your whole Leave Cert accounting paper. So make sure you can do this note. Okay, note number 6. A new warehouse was purchased during the year for 100,000 plus VAT. The amount paid to the vendor was entered in the buildings account. No entry was made in the VAT account. So, simple mistake made here with buildings and with VAT. So, our buildings figure, if we look at the trial balance, 713,000, and our VAT figure is 5,000 on the credit side. So we put the balances in first. 713,000, and the VAT figure on the credit side was 5,000. Okay. You should be able to work out 100,000 plus 13,000 VAT is 13% VAT is 13,000. Okay, we'll just write it anyway. 100,000 times 13% equals 13,000 VAT. Okay, that should not be in here in the buildings account. Okay, so we're going to credit 13,000. And we're going to debit VAT 13,000. That's it. So when we balance these accounts now, we will end up with 700,000 here and 8,000 here. So the 700,000 will be our fixed asset. Okay, I'll highlight that in red. Our VAT figure on the debit side will be a current asset. So two figures. 700,000 is our fixed asset, buildings. VAT has gone from being a current liability to a current asset just because of that. Okay, two figures. Working number 7, our bank figure. So, very simple way, first of all. We are going to have to do what's called a bank reconciliation. So first thing we always do, you look for the bank statement figure, which is here, and note number 3, which is generally a check not presented for payment. So we take the balance as per statement, 46,690. That's an overdraft, by the way, which is a negative figure. There's a check that hasn't been presented yet. We paid money out, it hasn't gone through the bank yet. So our overdraft is going to get higher. We're going to add check not presented of 560, and our overdraft therefore is going to be 47,250, which is a current liability in the balance sheet or a creditor less than 1 year. Okay, that's our bank overdraft figure. Now we're going to do a bank reconciliation with the other figures to make sure this matches. But If we make a mess here and it doesn't match, go with this figure for your bank figure. Okay, we're going to deal with note 1. We've already dealt with note 3. Tick that off. We don't need to do that again. Note 1, 2 months investment income had been paid directly into the bank. So look for your, just delete these a second. Your bank figure, okay? You're going to get this from the trial balance. It is 50,000 on the credit side. Balance 50,000 on the credit side. Just put it there. Okay, 2 months investment income had been paid directly into the bank account. Okay, let's look at that. 2 months investment income. We had a note back here on investment income. Go back. Note number 2. Okay. So initially, 4 months investment income had already been paid. So 7,000 was still owed, which was for 8 months. Okay. That 7,000 is going to be wrong now. Okay. Because we have to get another 2,000, another 2 months. Okay. So I'm going to take 2 months away from that. So let's see, I'll just do the calculation over here. 2 months investment income, which is 3%. If we go back to the trial balance, 3% of 350,000 times 2 over 12. Okay, when we do that in the calculator, that is 1,750. 1750. So that came into the bank account. 1750 went into the bank account. Remember, investment income due was 7,000. Now less 1750. Okay, I'll just less 1750 now means 5250 is our current asset. That is now our figure for investment income due. So that's a sneaky enough little note there, but that's our new figure for investment income due. Okay? And we put it into our bank account. Next, a payment from a liquidator was received directly into the bank. This represented a first and final payment of 25 cents in the euro in respect of a debt of 4,000 euro. So we received 1/4 of the money of a debt of 4,000. So basically we received 1,000 into the bank. The other accounts we're going to deal with are debtors and bad debt written off, because we're only getting 1/4 of the money. So we need to find our debtors. Did we change debtors anywhere? I think we maybe did. Our debtors figure is 98,800 from note number 3. Score that out. 98,800. 98,800 is the balance. Okay. So 1,000 we received, the debt was 4,000. The debt is written off. Okay, so the debt, bad debt that's written off, the amount we are still owed is 3,000. Okay, 3,000 is written off. We got 1,000. Our debtors goes down by 4,000, the whole debt. Okay, we're not going to get, we got 1,000, that's all we're going to get, so debtors goes down by that. So our new debtors figure, our new balance of debtors figure is going to be 94,800. Our new bank figure, when we balance all this off, what we are left with, so if I balance it, we get 47,250 on the credit side which, lo and behold, is the same as up here, which means we have done things correctly. It's basically 50,000 minus 1750 minus 1,000. So it's the same. So that's good. Bad debt written off. Bad debt written off goes in as a selling and distribution expense. I'll mark that in red. And the debtors figure is our current asset figure. Current asset in the balance sheet. Okay, I'll mark that in red as well. Okay, so we have 4 figures here. Current asset, debtors. Bad debt written off, 3,000. We have our bank current liability, our bank overdraft, 47250. And we have our investment interest due now is 5250. Working number 8. A couple of things here. The directors recommend that provision for investment income and debenture interest due. So these have already been done. There's the investment income due. Debenture interest due was somewhere around here. Yeah, debenture interest due 16,000. Already done. Okay, so I'm just going to put part 1 done. Part 2. Provision for bad debts be adjusted to 4% of debtors. 4% of, it's the new debtors figure, 94,800. So 4% of 94,800, which equals 3792. In the trial balance, it's 4,000. Therefore, we have a reduction, and the reduction is 208, which is a gain. Okay, so the 3792 you take away from debtors in the balance sheet, and the 208 is a P&L gain or other income, depending on what you call it. So 2 numbers there. Okay. Now, part 3, buildings to be depreciated by 2% of cost. Okay, so we just go back to our buildings figure. Here it is, 700,000. So 2% of 700,000, very straightforward, 14,000. That is your accumulated depreciation and also your P&L depreciation. Admin expense, that would be. And finally, part 4. The managing director should be paid a bonus commission of 3% on all sales in excess of 900,000 and 5% in excess of all sales above 1.2 million. So, sales hasn't changed. So first of all, 3% is going to be 3% of sales is 149,5000 minus 900,000, which is 17,850. Then also anything above 1.2 million, so 5% of that, of so 149,5000 minus 1.2 million. Make sure I have my zeros correct. And that gives you 14,750. So in total, 32,600. This is a selling and distribution expense and also a current liability commission due. So that's your figure, your total figure there. Okay, so those are the figures we are going to use in this. We have 3792 we're going to take away from debtors. We have 208, which was the reduction, which is an income or a gain. We have 14,000 depreciation on buildings, and we have 32,600, which is our commission, selling and distribution expense, and a current liability. That's all of the notes dealt with. So what I'm going to do, I'm going to run through the marking scheme quickly to make sure we know exactly where every figure is coming from. I'm going to tick them off as I go along. So first of all, there's 1 mark for the heading, which are given in the question. Sales does not change. That's a trial balance figure. Okay. If we look at these figures here, our stock figure didn't change from the trial balance. Our purchases figure, I think one of the last notes we did, and just look back through the notes, we have a purchases figure here, 1,066,000. That's worth a whopping 8 marks. And our closing stock figure of 77,000, I think that came from note number 1. So again, that's worth 6 marks. So big marks there. Patent written off, that came from our patent note, 4 marks. Salaries and general expenses, that came from our suspense note, which was this one here, 231,700. Big marks again. Loss on damaged stock, that was a note. Note 1, I think, 3 marks. No, actually, loss on damaged stock, where was that? 1,000. I'm just trying to, there we go, from note number 4 in our notes. And depreciation of buildings, we worked that out in notes. Depreciation of delivery van on loss of sale of van, 9 marks for that. That came from the long note on depreciation and disposal. Bad debt of 3,000, that came from the note bad debt written off. I think it was note number 7. Bad debt written off, 3,000. Advertising, can't remember changing it. It came straight from the trial balance. Sales commission, we worked that out on the very last note, note number 8, there's sales commission. Make sure you have the headings admin expenses and selling and distribution expenses. You will lose a mark if you don't have those headings. Operating income, discount, that came from the suspense note. No, actually, there was no note with discount. That's straight from the trial balance. The reduction in provision for bad debts, we did a note on that. Investment income, you're going to add that on. We worked that out. I'll just show you here. The investment income for the year was, where was it? Here we go, 10,500, note 2. And we take away debenture interest. Debenture interest was note 3, 32,000. We take away dividends paid, that comes from the trial balance. And we take away, this was a bit sneaky this year, if you notice, the profit and loss balance in the trial balance is on the debit side, which meant that was a loss, not a gain. This caught a lot of students out who lost the 2 marks here and then the final 2 marks. You take that away because it's a loss from the previous year. Just be aware. Balance sheet now. Patent, we did a note, 20,000. Buildings, we did a note, 714 depreciation, take away. Delivery vans, that came from note number 5 and the accumulated depreciation there. If we look back at note number 5, there's your delivery vans figure, there's your depreciation figure. Investments comes from the trial balance. Stock, note 1. Debtors minus provision, make sure you write it in exactly like it is there. Insurance company compensation, that was in the notes, note 4. Investment income due, we had a note there. Remember, that was a sneaky enough note to do with the bank reconciliation. Where was it? Bank reconciliation. We had, 2 months investment income here was taken away again. So 5250. VAT, that was to do with the suspense note. I think 8,000. No, that. Oh, that was to do with the buildings note. Yeah, here we go. There's your VAT, 8,000 current asset. Current liabilities, creditors did not change from the trial balance. Bank, we did a bank reconciliation. Commission due, the last note we did. And debenture interest due, we did a note on that as well. There's the figure you're looking for, 1,234,383. That is your, make sure you can do this. Your total, your net assets, current assets minus current liabilities gives you working capital. You add those two together, gives you this figure. That's what we're looking for below. 8% debentures, 400,000. Then we have our authorised and our issued share capital. Just quickly look at the trial balance to make sure you know where these are coming from. The authorised figures are up here. 1.1 million authorised ordinary, 400,000 authorised preference. The issued, 500,000, 300,000. Okay, that's where those figures come from. The authorised, you don't do anything with them, you just add them up. The issued, you keep going. Capital reserve, given in the question. Profit and loss balance comes from part A of the question. Add them together, you get 1,234,383. Thanks very much for watching this video. I hope it helps. Watch it again, rewind, pause, practice. Don't practice until you get it right. Practice until you cannot get it wrong with all accounting questions. Thanks very much for watching.